Hello everyone, Rodrigo Santano with Top Trader Academy here in Austin, Texas. Nice day outside today. The market's not moving much, which is great. I mean, it allows us to make money from simply passage of time. And today I wanted to cover a topic that's very important, which is when positions aren't safe anymore and why a lot of people get in trouble in this industry. It'll be logical but a little advanced. I'm sure everybody will enjoy it. Let's take a look. Okay, so let's go through it. Um, this is the presentation I'm going to use this afternoon with the Austin Association of Financial Traders, which is a nonprofit educational uh, organization, which I am the president of. So let's go through it. Topic is when safe isn't safe anymore. These are just the topics we've covered in the past. You can stop it and look at it if you want to. Um, this is just the agenda for today in our meeting this afternoon. Disclaimer, I am not a financial advisor and past results are not indicative of future results. You can pause it to read all the legalities with it. Let me know if any questions, of course. All of my trades are posted in Facebook, Twitter, and Google, plus Instagram. Those boxes there are the records of when I close a trade. I put all of them in there, full transparency. So as soon as I close a trade, I put, what instrument it was, what type of position it was closed as. Be mindful, they can start at a different position and end up as something else. So I just put whatever it's closed as, and the net profit, net of commissions. But when safe isn't safe anymore, most traders only focus on profits. But what happens when things go wrong, right? That is the question. Is your portfolio prepared for multi-standard deviation move? A multi-standard deviation move, it just means that the market is going to move abruptly either to the upside or the downside. Most commonly, it happens to the downside, of course. So let's examine why many people fail in this business. And this is a very crucial point. So let's just do very common examples to quantify what we mean by only focusing on the profits. Let's assume you have a $3,000 account where we want to make about $600 in profit on your positions at one time. And we will sell a straddle. A straddle is just selling a call and a put at the same strike price closest to the price of the stock. And we will see a profit and loss chart pretty soon of how that looks. So that whoever is not familiar with it can look at it. You can also Google what a straddle is in financial literacy. And on the other hand, we will sell a strangle. A strangle is also selling a put and a call, but they are out of the money at a delta of 0.16 or 16 delta. That just means that it has 16% probability of expiring outside those strikes that we sold. Again, you can look it up on Google. Due to time constraint, I cannot go into details. Some of our previous discussions have covered what these instruments are, and Google can give you a very good explanation of what they are. We will use actual market prices for this example. So a straddle with the average credit of 571 is what we're getting right now in the market. Simply means that we can make $571 per contract. And remember, in our previous slide, we said we wanted to make $600, so we will only do one contract. As you can see, there's a white curve here and a green curve. And with time, that white curve converges to the green curve and you make your profits. You basically stop making money if this instrument goes below $140 or above $152, right? So if nothing happens, you will make your $571 by expiration. And we're just assuming we're going all the way to expiration, which is when the white curve becomes the green curve. On the other hand, we can do the Strangle, an average credit of $1.25, which means we can make $125 per contract. Hence, we will do 5 contracts because 5 times 125 is the closest we can get to $600, which is what we were wanting to do in the beginning. So we'll do 5 contracts of these. Again, the white line will converge to the green line at expiration. And if the market stays where it is, which is at $146, we will come out with our $625 in profit. Notice the break-evens here are a little further apart. They're at $136 and $153. So everything looks very similar in both positions. You stand to gain around $600 if the market doesn't move, and many times that is what is going to happen, right? You will exit with your profit. No problem with that. The break-evens, which is where we stop making a profit, for the straddle is at 140 to the downside and 152 to the upside. You can go back and look at the graph again if you want to see that. Those are the circle numbers we had at the bottom of the profit and loss graph. And on the Strangle is at 136 to the downside and 153 to the upside. So the question becomes, which strategy would you choose? And a lot of people would say, I would do the Strangle because I can make just as much money. I am safer because to the downside, I'm protected up to the $136 strike and the $153 on the upside. So why not? Why not do the Strangle if it has better probability of profit for the same amount of profit? However, what happens if we sustain a 2 standard deviation move to the downside? This happens roughly 5% of the time, statistically speaking. We know it will happen, it's just a matter of time. And this is the problem, right? People start trading, they don't know what they're doing perfectly fine, but they keep trading and they keep doing well, and eventually a move like that happens. And it's not a huge move, it's just a move that will happen 5% of the time. That would mean that the instrument in question drops to a price of $130. So let's examine further what each one of our positions would have netted if that happens. So a move to a price of 130 in the market would generate a loss of $1,000 in the straddles, should we not defend our position. So let's just assume that we put the position on and we just wait to expiration and we just go with what happens. So we have $1,000 of a loss because we moved all the way from 146 to 130, right? Now, in the Strangle, the same move to a price of 130 in the market would generate a loss of $3,000 in the Strangles, basically wiping your entire account. So this is very important. In the previous slides, we said most probably people would choose this strategy because they feel safer. But safer is not always true. The fact that the break-evens are further out doesn't mean that you're safer. As you can see, a move of this magnitude, which is not huge, would have wiped out your entire account if you had chosen the Strangle over the straddle. Now, which strategy would you have chosen? Right now, in retrospect, you would say, oh, I would have chosen the straddle. But that's the problem. I mean, when you enter a position, that's the most control you have. You gotta know what position to enter and how many contracts to do. So it's really simple mathematics. Once the market has breached your short strike, which is the strike we sold to the downside, the straddle loses about $600 for every 6-point drop. Because remember, we got credit of about $6. And the Strangle loses much faster amounts of money. It loses $600 for every 1.5-point drop. So the slope of the curve on those charts is what gives you the loss per point. So what can you do? Basically, you need to learn to select the right strategy for every condition, right? I mean, you cannot just eyeball it and not use mathematics and not know what you're doing. You also would not let the market drop without doing anything. Like we said, in this example, we just assumed that we were going to be very passive and just put the position on and wait to expiration. You need to learn to defend your positions when they go against you. I would have never let that magnitude of a move happen without me taking action and doing something to protect it. Can it be prevented? The answer is really no, it cannot. Movements like that can and will happen when you have a healthy market. It is simply a matter of time based on probabilities. Like we said, such a move happens about 5% of the time. However, if you learn which strategy to use when, like you saw, and how to defend when things goes wrong, such a move will be of no concern to you. You will have a small drawdown in your account, not even the $1,000 we talked about. It'll be smaller than that, and you will be able to recover from such a move with no problem. But this is why a lot of people get in trouble. They think that something is safe when it's really not. And it works for a while, 95% of the time in this example, until it doesn't. And that 5% of the time wipes their account out. And it's very sad because it's simply a lack of education. So don't be the person that gets wiped out at the first small move. Education in this business is key. And I simply put the analogy of learning to fly a plane when learning to trade. I am a pilot myself, just for a hobby. And you cannot just learn a couple instruments in a plane and learn what lift is and what drag is and then say, okay, I'm ready to jump in and I'm going to go fly. It simply doesn't work that way. You really have to learn the whole thing, and you got to learn all the instruments. You got to learn all the, what's lift, what's drag, what to do in emergency situations, to be really a proficient pilot. And it's exactly the same thing with trading. You got to learn the whole thing to be a proficient trader. You cannot just learn this that I talked about today and say, okay, I'm ready. Let's start selling premium, right? There's a lot of things into consideration, and it's not complicated, but it's just quite a lot of stuff that you got to learn. Here is just the outline of what we cover in our courses. I wish I could spend hours and hours talking to you about all these things. It is just important that you recognize that it's a whole system that you need to learn. It's a whole slew of things, and I gotta spend a lot of time with you guys, hours and hours, to make you understand and help you understand all of this stuff. Key points here is we will talk about, how to identify the best candidates, how to create your portfolio. When the market is dropping is the best time to make money, but you gotta know how to do it. And most important is that you have 30-day WhatsApp support included with your course. What that means is WhatsApp is an app that you can download to your computer or cell phone, and we can talk one-on-one and clarify any points and go through many trades together with you so that you fully understand what you're doing. We have a trade repair roadmap that'll help us repair any trade we put on. This is invaluable and it's copyrighted. I think right now we still have the online course at a sale price. That's not guaranteed. That's going to stay like that forever. Right now, I think it's at $147. You just need to go to toptraderacademy.com, and on the top right corner, you will see something called all courses. You go there, and if it's on sale, you will see the sale, the course that's on sale and the regular course. So just pick the course that's on sale, the complete course. It's more than 6 hours of online videos, manuals, and samples. It includes a 30-day WhatsApp with me, where we can print screen screenshots, send it back and forth, discuss any ideas one-on-one or in the trade room with all the other traders. So I hope this helped. Always remember to stress test your positions to the upside and the downside to see what effect they will have. That is very, very important. Let me know if you have any questions. I know this was advanced, but let me know if you have any questions. You can send me an email at rodrigo_santano@toptraderacademy.com. You can reply to this. If you're getting this on an email, you can reply to the email, or just simply reply to any of the social media we have. Thank you very much and have a great day, guys. Goodbye.